Well, welcome to everybody. On behalf of the Women's Business Development Center, my name is Karen Goldner. I'm very pleased to welcome you to the second of our four-part series called Forward Planning on positioning your company for transition. I want to thank our sponsors, Barnes & Thornburg and EisnerAmper, for all of their work on this, as well as throughout the year. And I also do want to thank Allstate, who has brought us one of our speakers. So thank you all very much. A couple of housekeeping items. This program is being recorded. As was done last week, we will send you a link to the video along with the contact information for our panelists following the session to everybody who was registered. So if you want to go ahead and put up the next slide, please, Sarah. And I guess I should take this minute to also introduce my two colleagues, Sarah Bruck from our Twin Cities office and Cynthia Johnson from our Chicago office. Both of them are directors in our established business programs. As before, we really split up the very complex topic and huge topic of transition planning and succession planning into two areas: the internal selling to people you know, and the external selling to people that you don't know yet. And last week we kind of did an intro to all of it. Today we're going to do a deep dive into internal options. Next week, February 9th, we're going to be looking at external options, which is selling to strategic buyer or unrelated buyer, private equity. And then the last session on the 16th of February, we'll speak specifically about what does selling a business mean for my WBE certification. Today, our internal options are focusing on selling to management or transitioning to a family member. There's also a thing called an ESOP, Employee Stock Ownership Plan. This is another internal option to think about. It is very complex because it's pretty much all about tax law, and we're not going to be talking about it much today. However, when Sarah sends out the follow-up email, she's going to ask you if you're interested in learning more about ESOPs. We can set up a whole nother workshop that would be focused only on that very complicated topic, but we aren't going to have time to be able to do that today. Okay, so now what I'd like to do is introduce Lindsay Colden from EisnerAmper, and she will get us started.
Thank you, Karen. Hi, I'm Lindsay. I'm happy to be here. As Karen mentioned, I'm the moderator. I'm a director at EisnerAmper in the Minneapolis office. I work on corporate audits where often the company I'm auditing is owned by a family and the next generation is involved in the business. So this topic is very relevant to the clients I serve. Now I'll go ahead and ask the panelists to introduce themselves. Brad, would you like to go first?
Sure. Hi again to some of you. Hello for the first time to others. I'm Brad Frank. I'm a partner at the law firm Barnes & Thornburg here in our Minneapolis office. Like Lindsay, I work with a lot of family and closely held businesses and on both their corporate needs and as well as what we call private client services, which is sort of traditionally the estate planning practice, and also help regularly with transition of businesses, either to inside or outside buyers. And just quickly, Barnes & Thornburg, we're now one of the 100 largest law firms in the country. We have 22 offices with over 800 legal professionals working all over the country. Happy to be here.
Thanks. Beth Kiefer-Leonard.
I see I'm muted. There we go. See, even 3 years later on Zoom, it still happens. Hi, everyone. Beth Kiefer-Leonard. It's a pleasure to be here. I kind of wear two hats in this universe because I was the founding member of WBDC Minnesota. And that was maybe 18 years ago. So we're so excited because 18 years ago, there were 24 certified women-owned businesses in Minnesota, and now there's in excess of 450. And so you can tell that this is something that's really important to all of us in making in accelerating women's ownership. Right now, I'm the partner in charge of the Minnesota office of EisnerAmper, which was formerly known as Lurie in the Twin Cities market, for those of you who are in Minnesota. We're very excited because just like Brad said, they're one of the top 100. We actually moved from being one of the top 100 to being one of the top 15 firms in the country. And it gave us an extreme acceleration of the resources that we have. EisnerAmper has 3,000 employees globally, and we're in expansion mode. And so personally, our firm just went through a transaction. So I know that I'm not only personally have been consulting on this for the last 25 years. I can tell you what the personal stories are, not this time, but a different time. So great to be here, and I'm excited to be part of this panel.
Thank you, Beth. Lastly, we have Mel Clemens.
Good morning, everyone. I'm Mel Clemens. I'm also exclusive agent with Allstate that offers financial products doing mergers and acquisitions. We also have a member and partner of SAM Consulting, who facilitates businesses when they want to sell, retire, or they need succession planning.
Thank you, Mel. All right, well, let's get started here. First question I want to pose to the group. What are the cases for a sale to management, a transition to a family member, or those unplanned events like a death or disability situation? What are the major considerations for each of those? Brad, if you could start. You're muted, Brad.
I'm good. See, I feel much better.
Right, you're right. That's 2 out of 4 so far. I think the management one, in my experience, often sort of presents itself somewhat organically. I mean, I think over time, you'll come to find if certain key employees have an interest in coming into ownership. Oftentimes, we'll see people come into ownership in sort of a minority position, and then maybe move their way to actual control. That one is sometimes interesting because I think sometimes management thinks they want actual equity when what they really want is just participation in the upside and the profits, and not what a lot of us on this call probably know are the not so fun parts of being the equity owner. And so, but I think that's a conversation that we see, but oftentimes that one just sort of comes to be naturally as people sort of present themselves as very key employees. Family members, it often can go alongside that. I mean, sometimes they are the key employees. Other times, the family members may be key employees along with other non-family key employees, and that can present its own challenges. And then obviously, and Mel, I'm sure I'll have more to say about this, but death, disability, I mean, those kind of things obviously can come up very quickly and unexpectedly, and there's certain planning in advance you can do for those.
Thank you. Beth, anything?
Sure. I would say, I'm going to kind of add on to what Brad has said. A lot of times when we're working with our clients, or my experience has been, it's really, you have to disseminate what's best for the client, for the company. And then also, usually the family is also involved in that. And a lot of times, some of the most recent exercises that I've done with families in succession planning was non-family members were part of a management team. And it's been 5 years in the making of, if we're going to sell to those non-family members in the management team, how are we assured that we are going to get our money out? They have to be, so you have to really look at the competency of the leadership group. You have to understand that the strategy works. The world has changed dramatically in the last, let's call it 8 months. It was easy to finance something in the past. Now that looks a little bit different because interest rates are so high. That has to be a consideration as how you're going to be looking at, can you get paid out? Sometimes so that's a family member. In addition, and Brad and I have worked on this a lot together. It's really important to know that there are buy-sell agreements that are properly executed and that everyone understands. One of the things that I would say is the most imperative for any kind of management or any kind of family members is that there are conversations and communication about what intentions are. I would say the worst case scenarios are the ones where no one's talked about anything and that they end up, it's a drama for the family that doesn't need to happen. I can think of, again, some very key historical events in the Twin Cities area where someone just didn't believe they were ever going to die. And so, and it was a bank, and it was a large bank, and the family couldn't afford to pay the estate taxes. And so they had to sell. If they had been doing planning, it would have been a completely different result. And then the last thing is, in the management, I think Brad really alluded to this properly, is, people really want just a profits interest. Have I seen cases where those profits interests have turned out to be a down payment, if you will, on the acquisition of a company by management? Absolutely. And so I think, again, the communication is probably the number one, identifying what the strategy is, and then making sure that you have competent leadership that can take over.
Definitely. Oh, go ahead.
Oh, no, I
No.
was just gonna add to that. When you're getting into the transition of a business, and it depends on, like you said, the exact motive or method. So it's three things that we currently look at. Number one, is it planned or unplanned? So we have time, and when we're doing a acquisition or we're selling a business, then you got to determine, what is your true goal? Is it retirement? Is it keeping it in the family? Or is it maximizing your profit? So that's one solution to look at. And the other solution you can also look at is also, when you're dealing with a family member or management, there's always a way to do creative financing. I'm a little different than a lot of consultants or brokers. A lot of people will all acknowledge some of this, but we won't bring it up. Tax is a big issue when you sell in a business. And when you sell to a family member, there are more creative ways to do financing than when you sell to an outside person. But also on the flip side, you're not going to sue your family member as quick as you'll sue an outside person. So you have to also understand the consequences of doing an internal solution as well as an external solution. So those are some of the biggest things to think about. As far as death and transition, you have to have a succession plan, whether it's an internal or external. And you have to have a plan A, plan B, and a plan C. Just because you have it in your mind that I want to sell to my favorite son or my favorite niece, she's going to take over and do a great job. You have to have an alternative plan. And then you also have to determine, does this family member or this management person even have the capacity to relate to the staff that's in place? There's a lot of basic fundamental things you have to think about when you're selling to a management person or a family member, unless profit is the only method.
Definitely. It seems like a common thread is the communication piece that Beth was talking about. Never assume, we get caught up in that and just get everything on the table and be planful. It's very important. So we talked about kind of the cases for it. What about methods for selling a business? There's asset sale, there's share sales. Beth, you want to talk about that?
This is the place where I'm going to say the opinions I'm about to share are not for everyone's application to their own situation. It's just that this is methodologies as opposed to recommendations for you. If you're interested in this, you really do need to talk to your own professionals on this because it's very important. And you'll hear a lot about this. My joke on Monday mornings was that I was always nervous for the phone to ring because people went out over the weekend and whomever they were speaking to gave them 10 ideas that they thought were being, that hadn't been considered in their situation, which of course it wasn't exactly applicable. So that's what I feel like I'm doing right now. There's ways, again, depending on how you're going to transition. And I think Mel really alluded to this, is that there's creative ways to do it within a family member. And that is, if the company is a bankable company, which again, most in a transition, that's probably the case, then the company could actually redeem the shares of the person that's being bought out, and the person, someone else can buy those shares. That's one way. Another way is the person buying can buy from the family member directly. So that would be either way, that would likely be a stock sale. And that's where you hear people talk about capital gains treatment. There's also ways to buy assets that can be done that way also. And so really it is a very complicated mechanism on how you evaluate it. Sometimes the stock price or the purchase price changes based on the method. And I think that's something you often hear about because it's more expensive for the seller if you're selling assets, that's a general statement, than if they're selling stock, because that gets capital gain. again, creativity is the key. We've seen everything under the sun on how this works. And then again, I think the most important thing is what Mel was really talking about. If it's to a family member, there are very creative ways to transfer assets, which would be the ownership of a company to a family member.
Thank you.
Yes. Beth was actually target on, we're talking about the creative ways and the assets. A lot of your sales strategy is going to be based on your tax accountant or your lawyer who is a tax attorney. That's an invaluable resource when you get ready to transition your business. Most of the sales we probably come in contact, sometimes they devalue how much the tax liability is going to be. So that is a conversation you need to have early in the process with your CPA or tax firm. A lot of us offer that within the sale, but we're not tax professionals. We have other people. I'm on the mergers and acquisitions, so I evaluate the sale of a business, but I'm not your tax professional. So most of my sales are based on the asset sales because it's a little cleaner. And when you're doing share sales, it depends on if you were set up as a C Corp or a tax benefit or S Corp or whatever you were set up as. But the asset sales, a lot of time, like you said, is a little cleaner, but sometimes the tax liability. And I think we have some tax professionals that can talk about the goodwill. When y'all kind of talk about the structure of the sale, because some people don't understand that also will affect the outcome and the price, whether it's a goodwill, the asset. I don't know who's best versed to do that, if any.
I could definitely talk about it, but I think I'm going to let Brad go first about this topic. We'll have to decide how we're going to address goodwill because it's very complicated.
Thank you, because I don't want to answer that question. And so the other thing I was going to say about the methods of sale, but both, you know, the asset and stock, just also from a legal standpoint, there are a couple other things you might want to consider. The first would be, you know, depending on the way your business is structured, and we talked a little bit about this in last session, there may be certain agreements you have or permits you have or licenses you have that are not transferable, and or even if you do a stock transaction, upon a change of control of the stock, that may trigger certain actions under the agreements or the permit or the license. So, you know, that's something you'll want to take a look at early, just to make sure you're structuring things correctly, to make sure you don't unintentionally trigger those things, or that you at least have a plan for how to deal with those. The other thing is, and this is kind of getting a little bit at what Mel was just talking about too, is that this can be an opportunity if there are sort of legacy liabilities or challenging liabilities sitting around at the entity. An asset sale can be an opportunity to try and kind of segregate some of those liabilities into sort of the old company, and give a bit more of a fresh start for the buyer. But that, you know, that depends on the liabilities, who they're to, when they're from, and so that's pretty technical conversation and review, but it is, notwithstanding the sort of tax impacts of an asset sale, you got to balance that with, well, are there other reasons that an asset sale makes sense here? And is that worth something?
Great points. We've kind of talked about this a little bit, but how about financing issues to consider when going through this process? Mel, you want to start on that?
Yep, yes, ma'am. Financing is, other than taxes, probably the second most important thing to consider when you're looking at a sale, because if you have a sale and you're not able to get financing, then it's kind of going to be a mute day. So you want to make sure whoever you are negotiating with has the capacity to secure financing, and don't be afraid as a buyer to help them with that portion, meaning refer him to different financial institutions. If you have a bank or banking relationship that you've been in contact with for 10 years as managed a business, who better to have access to the records, the information, and know how the business is run. But on the flip side, do not get caught up and think that's the only financing company. A lot of buyers and sellers get married to one financial institute and can kill a sale. So don't ever get caught up thinking that's the only way. I always recommend people have multiple financing conversations with banks, lenders, or personal financing. And for a lot of sellers, sometimes personal financing is best because, as I will reiterate, the tax implications. So if you have some creative ways to do some owner financing or business financing, that will help you in the process, and it also help the buyer. Because a lot of buyers, especially when you talk about internal sales, and I'll just give you some examples. I've sold a couple businesses to a daughter who worked in the father's business for 15, 20 years. Their salary was not commensurate to what it costs to buy the business, but because they were working with their father, they could either waive the down payment or be creative with the down payment, but find a way to make it work. Because in some of these sales, well, probably majority of sales now, there's not going to be 100% cash out. I don't know too many of us who are still doing that, but I can't speak for everybody. But there's going to be creative ways, whether it's a portion down, an SBA loan, even when it's internal, there's going to be some financing available. When I mean also some owner financing, because a lot of banks and financial institutions want to have some skin in the game from both parties.
Let me just add a couple of things. One is I'm just going to tag on to what Mel was talking about. Seller financing, whether it's to your management team or to a family member, is often one of the best ways if the seller thinks that you're the most qualified buyer and that you have the most likelihood of being successful in continuing the enterprise. So that's, if you think about it in the big picture. So then what happens is the seller financing basically becomes a portion of equity, and they're saying, okay, I'm willing to defer my payment over some period of time in order for you to be able to continue to ramp up the business. I was thinking back to when I really started in this profession years ago, and that's what actually spurred the interest in women's entrepreneurship, because I realized that women business owners didn't have any access to capital. They didn't understand how to do succession planning. These are all things that, thank goodness, are not the case today. But I can truly remember, and I'm not that old, but I can truly remember when I had clients that, in order to buy a business, maxed out 6 or 7 credit cards at 21% interest to get the cash for a down payment on a business, and then had to ask their husband, which I really can't believe I'm saying, to sign on a line of credit on their home, because they could not get any access to capital. And so when I think about how things have really changed, it's really important that the more information anybody has regarding a sale, that you can't get enough information, because I would say you should never limit the opportunity to either buy or sell based on what you think is the one bank that you've dealt with for the last 30 years. That isn't how things work these days. There's also angel investors or people that are on the outside that think the business that you're going into is a great one and sees the future, and they're willing to put in what I would call outside capital. You might have to pay a higher rate of interest, if you will, but really that's the cost of entry. And so there are really creative ways for people to finance their opportunities.
I would like to say also, Beth, if she's been doing as long as I think she has, you'll often find out from minorities and also female, there used to be different rates and different terms. And if you wasn't hip to the game, you would go in thinking this was the case, and John Smith over there got a total different deal than you have. So it is very important to have certain banking relationships with honest people when you shop that, because you can find out from bank to bank from the same exact person on paper, it changes tremendously.
There's one more option that we haven't talked about, but SBA financing. And we haven't talked about that at all. And SBA financing, to Mel's point, hopefully really levels the playing field of opportunity of access to capital. Again, might be a little more expensive, and there's different terms. But the WBDC has been it has been a long-term partner with SBA. SBA has been a critical and important partner for the WBDC. And that is something that everyone should look at. And maybe it's a little more expensive, but the terms are going to be fair. The down payment is going to be less, and it is a very legitimate way to access capital. And I would say that the SBA actually looks at their investment as working capital. It's not just, they're willing to do more. And so that would be we haven't talked about that at all.
And sometimes when you do an SBA loan internally, they're willing to even finance more than traditional places. The only consideration you have to make is SBA oftentimes requires a certain amount of skin in the game. And if you don't have that access to 5 to 10% down payment. But unfortunately, we all know that's when the creative financing sometimes comes into play when you're dealing with internal sales.
Definitely. Brad, anything else to add on that?
No, I mean, I think
Okay.
Mel and Beth said it well.
Okay, great. Brad, I'll stick with you though.
Mhm.
Walk us through what the selling process would look like, selling your business to an internal stakeholder.
Yeah, so one thing we've sort of skipped past, and it plays into a lot of these different parts of the conversation. We talked a bit about this last session as well. I mean, a first part of the process is for the seller to figure out, is there some dollar amount I absolutely, quote unquote, need to get out of this, right? And whether that's for my next thing or for retirement or whatever. So, I mean, I think if you can get a sense around valuation to a degree, I mean, I think that is a good way to start, both valuation for what you need and evaluation of what's actually attainable in the transaction. And hopefully those are somewhere in the same area. And I think that's a good place to start. But then, as far as the actual process, first, we've been talking a bunch about who, but so assuming, you make the decision, whether it's management or family or some combination of the two, great. Then I think it usually is worth the exercise, especially if it's management, to first get the accountants and lawyers and other advisors involved early, particularly because in my experience, the accountants in particular will have a good sense of valuation, tax impact, and just what the cash flow of the business will allow for. But so you get everyone at the table and you have sort of usually I think a pretty open conversation when it's an internal buyer about terms and just, how much down, how much on a note or if outside finance, if there's going to be internal seller financing, what are the controls going to be set around the buyer so that, they can continue to, make a living and live their life, but you as seller know that your interests are protected. I think that's an important part of the conversation. And oftentimes it makes good sense to do some form of a letter of intent. I don't think you have to get too detailed and take up too much of your time and professional fees, frankly, in structuring that. But I do think it's good to put in some format on paper what our deal is, just so that you don't spend a bunch of money with outside professionals, getting to a point realizing you missed agreement on a certain material item, which does happen from time to time. And then the next step normally would be to get the documentation drafted, and both parties or all parties don't need their own representation. Sometimes it is worth it if at least, sometimes from the beginning, but certainly when you get to this point where there's, documentation being drafted, it often is good to have the buyer get somebody to look at it for them, just so they feel fairly treated, there's nothing they're missing, and there's no issue later saying, well, you didn't tell me that, or you pulled that one past me, or whatever. And I think if you can avoid that through just a few hours up front, that's certainly worth it. And then hopefully depending on what the financing structure is going to be, that can sometimes be the longest part of the process, frankly. As you get ready to close, just getting that all lined up, particularly given, like Mel was just talking about, some of the SBA's requirements right now.
I think, Lindsay, that also, I don't know if we skip this related to our next question to talk about the process. I don't know if we can talk about that now, just a big shot overview of what the sales process looks like.
Yeah.
So I'll start, and I know we'll all chime in. The first thing that I like to do is, number one, know the goals of the seller and the family, whether it's internal or external. Know the goals, what are your goals are. And the number two is you need to get a true evaluation of your business. Don't go by what your granddaddy told you 35 years ago. Don't go, well, my cousin said we should get this amount. What normally we do is take our tax returns and we multiply them by 2. That is not the accurate way to sell your business. So make sure you get a real evaluation of how much your business is worth, either based on comp sales, based on finances, or based on what an intermediary. Brad was kind of alluding to an intermediary. When you sell with a family member, your consultant or broker or the consultant firm will act as an intermediary because he's representing kind of both parties and he's making it fair for everybody. But after you get evaluation, then you determine, like you said, how much do I need up front? What am I willing to risk? Sometimes you say, I'll take a lower sales price to get more money up front, or the reverse. Sometimes I'll take a higher sales price and get it over a longer term to lower my tax liability, or to ensure that the buyer has the necessary cash flow to sustain the business. Because if you're selling it internally, that's going to be your number one thing. Can my internal candidate or my family member sustain the business at least long enough to get you paid? Oh, hopefully in perpetuity, but at least long enough to pay off the owner financing.
Mhm.
And then once you come to a term, as Brad said, get a letter of intent. In my letter of intent, I want to see price, contingencies, and a little skin in the game. Because once you have that conversation with an internal candidate, whether it's a management person or a family member, the word is going to get out. No matter how much we want to keep sales confidential, somebody's going to be sniffing around and find out. And what you don't want to do is damage your whole operation and corporation with somebody who might not even buy the business. So I'll let Beth pick it up so I won't go.
No, I'm laughing because there's 2 things. One, I think I've learned this also. The value that the seller believes the firm is worth or the company is worth is never what the buyer thinks. I've yet to see any time there's a meeting of the minds on that. Actually, I think I just had one that closed that exceeded their expectations. So that was great. But it's never, you always think your company is worth more than the buyer is willing to pay. And that's just, because you're wedded to it. It's all you've done. It's how you've created your value. One of the things that everyone was kind of alluding to is sometimes the seller takes an earnout. And the earnout means that here's the purchase price today. You have to hit certain milestones in the future. There's an upside related to it. I have seen in my experience that most of the sellers get their guarantee piece, that they believe that is what they want. That's their minimum. And then anything in an earnout is gravy. I've seen that a lot. Usually, the buyer ends up exceeding the earnout value. That's probably more in a management buyout than a family buyout, just because the management has incentives in what they're trying to accomplish. And then one of the other things that we talked about is that valuation. It's, again, much more sophisticated today than it was even 15 years ago, with quality of earnings, independence, people doing things independently. Even with a sale to a family member, it's probably good because, again, the estate planning tax ramifications, if you sell for something that's lower than even the market would bear, it ultimately could be deemed a gift. And that would be something that would be a problem for the seller down the road. With gifting, the time frame of looking back is 100 years. I mean, I don't know if that's an exaggeration, but there isn't really a time frame that it ends. And so that's something that's always an important consideration, that it's not considered a gift if you're doing it to a family member.
Beth, while we're on that topic, are there other tax considerations? You mentioned that.
There's tons of tax considerations. Put this in a bucket that's manageable. Again, capital gains treatment, very important. Figuring out what the ultimate liability is. I have seen definitely places where, or situations where somebody's more concerned about the income stream than they are about getting all the money up front. There's something in their psyche that says, if I know I'm getting X amount of dollars over a period of time, then I can manage my life. I've seen that, even though that may result in something that's more tax, if you will. And then what I would say is one of the biggest considerations is that while tax is very important, it's actually not, it shouldn't be the ultimate driver of a transaction. And so that's almost a lecture that I give clients when they embark on this process. And that's because I think it's really important for people to say, if what you've built and what you want to continue is what's important, then sometimes everyone has to compromise, and the compromise might be on, what's the most important attribute that you're trying to solve for. And then the last thing is, having just recently gone through this for our firm, one of the things I have, consulted on M&A deals for years, decades maybe, until you're in it, you have absolutely no clue what the professionals do. That because what both the accountant and the lawyer and the investment banker, as Mel is, they only see the part that they're involved in, but when you're on the inside going to the outside, I would say my perspective has changed 100%. And if anyone had told me it was going to be the magnitude of the work that needs to be done, I feel like I have a new perspective on consulting for clients that are going through M&A today than I did. And I've been doing this for years. And I can't speak to everyone else, but I can just tell you, being from the inside to the outside, it's a whole different deal.
Definitely. One thing I know is that since the purpose, the focus is internal buyers, two things I would like the panel to also consider, or the listeners, is number one, if you are considered internal, it should be a plan. Like, you should have a conversation early. You shouldn't call John on Tuesday and say, I'm selling. Now, what do you want to do? You should be transitioning that person, especially if it's a family member. You should be mentoring, training, having conversations to prepare them and get them ready for the sales process. Because, I mean, that's the easiest transition, somebody internally, and you have the time to have that conversation. But also be prepared when you have those internal conversations, that once you start opening up the books, it might be some questions about how much money you're making, how much I'm making, and then those get a little touchy. So always be cautious when you're selling internally, and make sure this is a person who has integrity that you hope. So if they decide not to purchase, to not to share the books with everybody, to not to take it personal, to not to criticize or point the finger at how much you were making, I was making, or I should have been making. Because that happens if you've been in this business long enough.
Great
An
point.
NDA is only as good as the paper it's written on at the end of the day.
Right.
You can try to pretend. Brad, I guess you could speak to, how many times are you actually successful in enforcing the NDA?
Yeah, no, they are,
Right? I mean, that's
yes, most people view them, and frankly, some courts view them as suggestions rather than actual documents. It's like a speed limit, right?
Yeah, what I tell my clients is, do business with somebody you trust. Because, Brad, what is the only way to enforce an NDA?
An injunction, but
Yeah, you're gonna have to go to court.
yeah,
And I'd rather do business with somebody I trust than trusting a piece of paper.
no doubt. No.
So,
and even if it's a family member, because actually Brad and I are working on an example right now, a mutual client, where they're looking to sell to their family member. And the last step was actually opening up the books completely. And it's, it was very emotional for the owners, the founders, because of what they built. And, it's a business that has ups and downs depending on the economy. And so when they finally got into the headspace of being able to say, I'm going to share the information, it was very, very emotional for them.
and that's another thing, Beth, you brought up, is if you are selling your business, nobody likes your car more than you. So take those emotions out of it. Because I trust Brad when he says, do not get offended. Do not. Take your emotions out of it. Let somebody be the go-between, even if it's you and your daughter, your sister, whoever it is, because those money is not worth losing a sister over.
Right.
It's not worth having a daughter mad at you for 25 years over how many ever zeros. Take the emotions out of it. Let somebody else be the go-between, CPAs, consultants, brokers, or lawyers. Let them deal with that. It's worth the fee to save family emotions, because that's what will happen.
So I have two comments. One is, after being in this business, for this period of time, I can only say the number one thing that destroys families is money. And that is, I don't even think there's a close number two, honestly, but money, forget what the context is, but money is definitely the thing that people fight about the most, even if it could be that they're fighting over $10, $10 million, or $10 billion. I mean, it doesn't matter, because whatever it is, money is the only thing people fight over that destroys families. And I think it's a delicate balance. And then Ellen asked a question that says that, I'm just going to read it. I heard that if you get a valuation, and so Mel was talking about that, and then sell it less than that valuation amount, the buyer has to pay taxes on the difference if it was a gift. And again, those are conflating two different concepts. And I want to be really clear about this, because it is a confusing, very, very confusing area. If something is deemed a gift, so let's say you get your valuation says 10 million, you sell it for 5 because you love your kid the most, and that 5 million is deemed a gift. It's only at the time of well, if you haven't used your lifetime exemption, which I'm not going to go into, then that $5 million goes into the bucket of your lifetime exemption. If you exceed your lifetime exemption, at some point you will pay tax on that at the gift tax rate, or the estate rate. That's completely different. The gift isn't determined and you don't pay tax on it at the time of the transaction. It goes into the seller's estate planning bucket, and that's completely separate. And it's very confusing, and people ask this question all the time. And so I'm glad you brought it up, because it's a hornet's nest of an area. Probably not more of that today. So,
But I've done a lot of transactions. I don't have experience with that, but I think we'll always say some businesses are sold at a discount. So if you sell a business at a discount, that does not mean your sister or your brother has to pay taxes on that discount.
That's
But
right.
like she says, if it is, that's when you're arguing with the IRS. If they do come after you and say, wait a minute, Beth, we know you sold that to Brad because that's your favorite cousin at a 90% discount. That's different. So now businesses are sold at discounts for various reasons. And also the valuation is, it's arbitrary. It could be, Beth could evaluate it this way, Brad could evaluate it this way. So don't be scared if you think that you're giving a good deal. A good deal does not mean a gift.
That's right.
Unless the IRS says it does.
Right.
There's a follow-up question on if it's to an outside party and not a family member.
Right. And I
That-
think that's what Mel's just saying, is that
Yeah.
the outside party's valuation, it's arm's length, I think less concern. The issues come up for difference between valuation and purchase price when it's a family member, frankly.
Let's talk about insurance. So Mel, this is your wheelhouse. Why does it matter? What's key considerations for the seller on insurance?
I think when you're doing owner financing and doing family business, sometimes it plays a bigger portion. So I'll give some real life examples, and I'll use Brad and Beth because I keep saying their names. It makes it easy. So say if Brad owner financed his firm to Beth, and the purchase price was 10 million. Beth was only able to secure 9 million up front, so she's $1 million short. So Brad concedes to owner finance that $1 million for 10 years. I do 10-year terms. So for 10 years, Brad is going to loan Beth that $1 million, what they call owner finance and seller finance, and whatever term they call it. So one way to protect Brad, just in case something happens to Beth, is to do a simple term policy to cover it. So that's a simple way. You'll do a term policy to kind of hedge your bets. Meaning if something was to happen to Beth, meaning incapacitation or death, whatever type of policy you get, then that will cover that portion. Who else wants to chime in about, the insurance, how do you use it in sales?
Yeah, no, I think that's, I agree. I mean, I think that's a really good use of it. And frankly, sometimes once in a while, you'll see banks even ask for that kind of thing when they're financing.
Yeah, definitely.
Because everyone here is betting on this person and their success, and so I think that can be a really useful tool. And depending on the people and everything, and I think Mel you would echo this. Like, it doesn't have to be super expensive even. I mean, if it's a 10-year term policy, someone's relatively healthy shouldn't and shouldn't cost too much, which is nice.
No, definitely. Also disability policies. What you're trying to do is ensure that your money's recovered if you do owner financing. That's the basic need of that. Also, if you have different type of policies with wealth in them, meaning you have cash value, sometimes we use that as an asset for the sale.
Yeah.
Especially when you have a management team, you might have had a policy on them for 20 years. So sometimes that is used as collateral or down payment or various uses.
And just to give a slight nuance to that also, if you have insurance policies on key persons in your organization, sometimes the financer, asks to have that given to them. You assign that to you already have a policy in place. They say, can you assign it to the value? So let's say it's $5 million policy. They say, I want you to sign that $1 million that you still owe on this $10 million transaction. And again, oftentimes companies have assets that they don't realize they have that they can use in a transaction. And so that's one of the things that I think is really important to think about is what do you have out there? How can you use the assets that you've built? Sometimes if, in a transaction, you're not going to, the buyer doesn't want all the assets. Some of them really are either attributable to the seller, and there's ways to get those assets out. I know we're talking about structure a little bit, this might be kind of walking down that path. But a life insurance policy is and disability policies are just another one of the mechanisms that you can use to provide additional backup collateral, if you will, upon death or disability.
And most banks, as Beth was saying, are going to require, they're not going to give somebody a $10 to $20 million loan without some insurance. They're going to say, if I loan Diane $10 million and she dies, we want to still be paid. So they're going to have that insurance is going to be needed that way. And also, like for the buyer seller, if you're doing completely owner financing, you're going to want to have that insurance. So a perfect example. Go ahead. I think somebody's speaking. Perfect example is like we're saying, anytime you're financing with your mother or your daughter, and also when you're doing for tax simplification, sometimes people want to put that money into a life insurance policy to save. Mm-hmm. Yeah, so it's a lot of ways insurance is used.
Thanks. I want to make sure we get to this question that was submitted from session 1. So in a scenario where there's 50-50 owners, kind of the best course of action, which I know there can be many courses depending on the situation, but would it be better, for example, the company to redeem the shares first and then the legacy owner purchase the shares from the company, or the owner directly buy out the other owner, or some other scenario? I know there's agreements usually in place and things like that. So Brad, if you want to kick it off.
Yeah, I mean, I guess to your last point, Lindsay, our strong recommendation if you have 50-50 ownership situation would be that you have some kind of agreement in place, whether it's what we would call a buy-sell agreement or shareholders agreement or operating agreement. It just depends on the entity and what you decide to call the agreement. But conceptually, they cover lots of things. But oftentimes they will talk about what happens if one of us wants out. What happens if we don't agree on which one of us should be out, and what happens if we have a deadlock. You can cover sort of the whole landscape of things. But I think that sometimes we'll talk about what the plan was that you at least agreed to however many years before. But to kind of kick it over to Beth a little bit, I mean, honestly, I think let's assume everyone's sort of on board with that. One of us is going to be gone and maybe somebody else is going to then step up. In my experience, it's almost always driven by the tax impacts of the way you structure it.
It's absolutely true. I think Brad's being modest. I would say we lean on the lawyers for sure in this kind of a scenario, because we hope that there is something that is definitive, even though you can't anticipate every circumstance, with a buy-sell agreement, regardless of the type of entity. Ultimately, it is a tax. It's two things. What's the intention of the surviving or the legacy owner? How are they going to, what is their plan? Are they going to turn around and sell those shares to somebody else to buy in? So if that's the case, then they would probably want to buy those shares themselves if they can, because then they have higher basis if they're going to turn around and sell them. And I know that that's a question that has come up as, are you buying from the owner? Are you buying from the company? When you buy from the company, the money goes into the company, and the only way it comes out is either as a distribution or some other mechanism. If it's a C Corp, it's a whole different conversation, which I don't want to get into right now. But the complication is really by the type of entity that you are structured in. So S Corps are different than C Corps. C Corps are different than partnerships. Partnerships are different than LLCs. All of those things have different tax attributes, and that's probably that's the driver of what's the best for the seller or the organization that's redeeming the shares. I would say 50-50 owners are probably, in my experience, where you run into the most problems at the end of the day, because it's uncertain, who decides who's not working, who decides who wants out, who decides whose life has changed, who decides. It's very, very difficult. And that's where the shareholder and operating agreement is the most important. What if someone wants just ready to, cash it in, but they don't want to sell?
Right.
That's actually probably one of the biggest issues. And so you don't want to force that redemption. And a buy-sell agreement or an operating agreement really is the driver of those. So number one, call your professional. If you don't have a buy-sell and you have a partner, that would be my recommendation. If you said anything out of today, that would be number one if you don't have it.
Well, let me jump backwards. Hopefully, it's already been done, like you said, in their operating agreement, but a lot of times we know that's not the case. So if you're now considering on bringing in a partner, what I've always tried to do when I structure buyout clauses for both parties in the initial stages. So once you get to the point where somebody's ready to go, there's not an argument, there's not a finger pointing. Have a predetermined evaluation, whether it's based on revenue, a multiple of revenue, or based on whatever dollar amount or percentage you invested. So when it gets to that point, it's no confusion. I always do a 3-year buyout with every deal I structure, because if you take on what they call a management partner or a general partner, whoever's the person I'm doing the day-to-day, you want to have an option for them to be bought out, whether it's a family member or not. So that's what I would recommend in the initial stages. Now, once you get to the part where you 50-50 owners, it's really too late. It's anything goes. You have to agree, or you watch a business go down.
Yeah.
You see that when you have two people who own 50% of the business, they don't have a clear set of rules and regulations how decisions are made when it's time to leave. There's an argument.
Yeah.
And another way we didn't talk about insurance is if one of those 50% partners dies, you should have that partner bought out, because I didn't agree to be in business with your husband. That's not what we said. I went in business with you.
Right.
So when you pass or I pass, you buy me out. I just went through that with one of my closest friends in Alabama. They own 9 different franchises. And luckily, the other family member was amenable, but he didn't sign up to be in business with the wife or the husband. But luckily, he bought them out. Both of them agreed, and we negotiated a fair split. But normally, you should have a buy-sell agreement that if I pass away, you buy my proceeds out, you own 100% of the company. But if you don't, then Brad is going to be arguing in court, or Beth is going to be arguing in the boardroom about what should have happened.
Brad and I only like to be working on the same side.
I don't think I want to go against y'all either.
Yeah.
Lindsay, I just wanted to let you know we probably have time for 1 or 2 more questions before we switch into the breakout rooms.
Okay. How about fiduciary duties to partners, co-owners, shareholders? What kind of are those parameters that should be followed? Brad?
Yeah. So this is going to apply when you have a partner or co-owner or whatever. Fiduciary duties are a large and complicated subject, but generally, I mean, to boil it down to very basics, as long as you're being transparent and fair, you're unlikely to run into fiduciary duty issues. But the most common fiduciary duties you're going to see in a business like those we're talking about, most common fiduciary duty issues you're going to see are where people aren't treating people sort of pro rata unless you've already agreed to that, not unequal treatment. You'll see issues sometimes with people like taking opportunities for the company that should go to the company, but they decide to keep for themselves. That we see sometimes. Sometimes you'll see if it's two families, like one family getting better opportunities than the other within the business. But I guess, in the sale of a business or the transfer of a business, again, you're going to hope and assume that there's a document underlying all of this. And so then you're moving away really from fiduciary duties into just making sure you follow what the buy-sell agreement says. But, I do, again, think that as long as you are, being on the up and up, you're unlikely to have to worry too much about fiduciary duties. But really, if you start being accused of violating fiduciary duties, or you're worried you're bumping up against something that just doesn't feel right, of course, a lawyer's going to say to call a lawyer, but really, you probably should call a lawyer because it's not something that you can just like Google and say, "Am I following my fiduciary duty?" It's a much more subjective, unfortunately, analysis.
I'll ask one more here. What are disclosure obligations that should be considered? Beth, you want to?
I'm gonna actually let Brad start that.
Brad? Oh, sorry.
It depends.
Because this is definitely the legal
Yeah.
side of it.
Yeah, and this falls kind of in the fiduciary duty
Yeah.
as well. I mean, disclosure to who, I guess is the first question. If it's to your partners about disclosures of possible offers that are being made to you, likely you have a duty to disclose that. But it's going to be kind of time specific, or event specific, and frankly state specific. As far as to a buyer, do you have to do what kind of financial information do you have to disclose? What kind of information about the company do you have to disclose? I mean, that's going to be set out in whatever agreement you enter into between each other. And the buyer's should have their opportunity to do some level of due diligence and review all those things. But the ultimate agreement you guys sign when you do the transaction, that will make representations by the seller to the buyer saying, I told you X, Y, and Z, and so now I'm sort of, my hands are clean of it. And so that will likely drive how much you do have to disclose.
And the only thing I would add to all of those recommendations is that even if it's a family member or a management person who's been in their business for the last 100 years, you still need to disclose, and you still need to make sure everything is on. You can't say, well, they know this because they were working here. No, the disclosures are probably the most important part of the entire document or in any sale.
Yeah. Yep.
Great.
Well,
Sarah, yeah, go ahead.
I was just going to say thank you so much. The timing was impeccable. And thank you, Brad, Lindsay, Beth, and Mel for providing such helpful information to us. And thank you to our WBEs for joining us today. We're at the point where we're going to head into breakout rooms. And these breakout rooms will be roughly 20-15 minutes. And at the close of the breakout session, then we'll come back as a large group for a little bit of follow-up and some closing. The 3 breakout room options are Beth Kiefer Leonard. She is the partner in charge in Minnesota with Eisner Amper, and she'll be hosting a room to discuss issues related to tax issues. And Brad Frank, who's with Barnes and Thornburg, who's a partner there, he will be hosting a room to discuss legal matters. Mel Clemens, who's owns his own business, Sam Consulting, specializing in business brokerage. He's also an Allstate agent, and he'll be hosting a room to talk about insurance issues or items related to business brokerage. If for some reason you aren't able to select the room, just unmute yourself, and our resident expert, Karen, she will make sure you get into the right room. But now's the time to go ahead and sign into the rooms you're interested in, and we'll see you back in just a little bit.
Looks like Beth's room is waiting to the last second, but they'll be back in shortly.
Okay.
Mhm. Here they come. All right, I think everybody's back. Lindsay, if you want to just give us some closing thoughts and then I'll wrap up.
Sure. Beth, would you want to finish your thought? I think you got cut off there.
My comment, and I said it's not to toot our own horns, but
Oh, sure.
but it was really about making sure you get the best professional advice in a transaction. Whatever you pay will be worth it because it will provide protection for you in the future. It will ensure that you're maximizing the opportunities financially, and it'll be best for everybody moving forward. That was all I was going to say. So it's not to be self-serving, but it sounds like it. I am.
Right, right. Well, great to hear from you all. Brad, Beth, Mel, thank you so much for your time and input. This session was great. I was in on session 1 last week. That was also so great. This followed up very nicely and complemented it. So thank you again. Karen, I'll kick it back to you.
Thank you. So hopefully folks got some good thoughts, food for thought about looking at opportunities to transition your business to an internal party. Next week, we're going to be focusing on transitioning your business to outside parties. So whether that's a unrelated buyer or private equity, those kinds of topics. So we'll be having our just a tremendous panel again for that, and we'll do the same format with some breakout room opportunities. If you registered for this event, which you did because you're here, then you don't need to register again for the future ones. You'll obviously, it'll be the same link. As I mentioned at the beginning, we will be sending out the recording following this event, so probably sometime tomorrow, along with contact information for our panelists, and we encourage you to reach out to them. There were several people who provided questions via email responding back to Sarah, and we were able to incorporate those in. So if you have additional questions that would be appropriate on either on the external sales side or on the certification side, which will be on the February 16th program, please feel free to respond with that. And also, please let Sarah know if you have interest enough in learning more about an ESOP opportunity that you would show up for a workshop, because we would love to put that together if there is interest. I want to just close up again by saying, and I think that we've talked about the importance of trusted partners, and we are just really at the WBDC so grateful to have Barnes & Thornburg and EisnerAmper, formerly Lurie, as really trusted partners in our work, and very much appreciate Allstate's introduction to us of SAM Consulting. Mel, you've just added a lot to the program today, and so wanted to thank you all. And I think that we will then wrap up and say goodbye. Enjoy the rest of your week, and look forward to seeing you next week. Thanks, everybody.